We still have a 2-year gap in terms of timing for those things to come on board. I still see silver prices going well up over 120 and potentially like moving towards 180. China has basically been evaluating this increase, which is why they're stockpiling silver. More gold throughout the world was acquired, but there's more than that going on. And there is a bit of a supply problem coming up. If those mines are disrupted, there's not a lot of supply to come in elsewhere. You don't have to get much higher than where we're at right now to really push the price of gold up. To find a new mine, to get permits, do all these things can take anywhere from 10 to 25 years.
Dr. Nomi Prins, economist, author and founder of Prinsights Global. It is a true pleasure to host you on Palisades Gold Radio today.
Thank you so much.
Excellent. Really excited for our chat today, Nomi. And we've seen a tremendous increase in volatility recently in the precious metals complex. I mean, just last Friday, the 30th of January, gold went down close to 10%, silver close to 40% down in a single day. Is this increase in volatility indicative of a bull market being on its last legs? Or is something else perhaps going on, something else driving this increase in volatility?
Those are excellent questions, which I think have been on the minds of many people that were already invested or thinking about investing in these precious metals. A lot happened on that day that served to increase the volatility and the downward momentum in both gold and silver by more than gold, and silver more than gold because a lot of that was paper trading. There were margin announcements, there was program trading, there was limits that happened within program trading that were taken out, which then kind of facilitated additional limits being put in and those being taken out. So there was a lot of selling that happened because selling was happening. It wasn't like the world woke up that morning and said, you know what, silver is 30% overvalued. So a lot of that was based on, as vicious as it was, a confluence of technical events. And the narrative went that it was also related to, because it coincided with President Trump's appointment of Kevin Warsh to be the new Fed chair when Powell's term is over in May. And somehow that was negative because he would be an inflation hawk. Don't know why that's negative for silver and gold. It hasn't proved to be so in the past, but in either case, he's not. He presided over 5 years at the Fed, where basically had it most acute period of easing and quantitative easing net of COVID in its history. So a lot happened. And gold, of course, also traded off less than silver. We've seen rebounds in both of those metals, not to where they had been before that sell-off, but certainly moving in that direction. And in both of those metals, we're still up year to date.
No, definitely. That's a good point, to zoom out for a second. We're in the midst of an incredible bull market and they're still up year to date, like you just outlined. We're seeing a significant premium on silver when we look at Shanghai, exchange that trades mostly in physical compared to the West, COMEX and London. I believe right now it's about $16 an ounce, which is a substantial premium. Where do you think this is coming from and what's driving it?
So when we look at mostly what's happening in Shanghai, what's happening in the East, where the buyers are from the standpoint of institutional, central banks, individuals, wealth funds, there's been much more investment in physical silver, and there's much more of a desire to increase investment in physical silver and physical gold. And the reason for that is geopolitical, it's store value, it's diversification, there's a lot, historical legacy purposes. So there's a lot of reasons, in addition to the absolute necessity for industrial development and growth, that require physical silver. You can't build solar panels out of paper silver. And so there's a lot of reasons for that accumulation and the desire to pay a premium for that. And we saw that premium happen before the sell-off. That premium was already embedded because of that connection to wanting more physical versus paper silver. What we saw at the SLV, the ETF, which was one of the sort of most prevalent initial downward turns in terms of a paper trade, even though it's technically supposed to be invested in real silver, it just didn't have the time. It wasn't selling real silver. It was the sort of having this sort of paper trading go on. And that same logic happens when the SLV or paper types of silver proxies go up. And there's less of a premium for them as they're going up than there is for the physical silver because of that very reason, that also produces volatility on the other end. So that's really why we're seeing that disconnect with the physicality. The supply deficit of silver is global, but the desire to do something about it and to invest in physical silver is more prevalent in the eastern side of the world than it is on the western side of the world. And that's why we're seeing that premium. But what that premium also shows us is that the appetite for real silver, which is global, does exist. When we look at China, for example, that just put in place export controls on processed silver as of January 1st of this year. They did that because they want to keep silver for development purposes, industrializing purposes, in their control, and not in the U.S. control. And at the same token, the U.S. put silver on its critical mineral list in November. So there's definitely a need for the physical. It's just that it manifests more because of those reasons in the East.
No, definitely well understood. And that battlefield that you're outlining there, that critical mineral battlefield, is of course very interesting, and I would love to unpack that more in just a second. But you don't believe this is an arbitrage that should close over time? I mean, this premium has been there for most of January, like you already outlined. If it's a battle between paper and physical, it's not something that we should expect to close necessarily. So how could this resolve?
Well, I think it will close over time, because the reality is that as many paper sort of speculators in silver as exist, they are battling the fact that there is a dearth of silver supply. We're entering our 5th consecutive year of supply deficits in silver. And in fact, the total deficit over these last 5 years now equals the amount of silver needed for a 1-year period. And that's if demand doesn't increase. So there's a time gap that also exists that explains some of that $15 premium. And I expect that to close as the need for physical silver increases. And let's not forget, it's going to be 2 years. And we did analysis on this for Prinsights towards the end of last year. It will be 2 years before there's a new operating mine of high quality silver to enter the supply chain. So it's not like there's something waiting in the wings to show up to really close the need between supply and demand for silver and to fill that need, which means that more physical silver buying is going to happen in the West as well. And that's going to have the effect of closing some of that gap.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Gold Corp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a significant stake in newfound gold. Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show. That's an incredible gap in supply and demand that you're outlining there. 5 consecutive years of supply deficits and almost a full year or over a full year of demand, being in deficit. That's truly, truly incredible. Is the price that we're seeing for silver right now enough to incentivize additional supply to close that gap over time?
That's a really good question. It is, because there's a lot of evaluation for existing silver mine, because silver prices have gone up so quickly. They're still being evaluated at old silver prices, even last year's early silver prices, which were under $30, $40 an ounce. So there is a lot of reevaluation that will take place at the mining level, and that will also mean that miners, the bigger ones that have been producing high quality silver into the market, will look around the world and say, okay, what are the junior mines that are out there that are close to production, that maybe have permits in place that we can acquire, that we can try to get supply going more quickly or something like that. We still have a 2-year gap in terms of timing for those things to come on board. But there's certainly a circling of that gap based on where these prices are. And I think at these prices, and if we look at where they were the middle of last week as opposed to the end of last week, I still see silver prices going well up over 120 and potentially moving towards 180, which is a 50% increase, which is less than what we saw last year. It's almost a third of what we saw last year at its height over the next year.
All right, $180 silver. When we talk about the demand side of the supply and demand dynamics, at some point, of course, the price of silver will catch up and, pinch margins for industrial applications of silver. What would that price point be when it really becomes a pain point?
Yeah, I mean, I think that was, in terms of pain point, really also depends on how much silver has been put aside and so forth, and how much accumulation is going on over this time. So I don't know what the exact pain point is in aggregate. It really is very much dependent on which industrial use you're talking about and how much stockpiling there has been. That is one reason why, just earlier when we were talking about China has basically been evaluating this increase, which is why they're stockpiling silver, which is why they're keeping silver in the country so that they can lock in the lower prices so that when silver goes up in price, they're basically not starting from scratch. So I'd like to be able to answer that in one number, but it really depends on what the growth is per an industry, where they've locked in silver, how much they have stockpiled, and how much they're sort of accreting that value and the potential cost up as the price goes up. So I think if I had to average, you are probably looking at somewhere between 150 to 200 over the next couple of years where it starts to get painful. But that's one of the reasons why we're seeing, sort of a need for supply, and why I think this latest sell-off is really short-lived.
All right, well understood. I would love to transition to gold for a second. Of course, like we outlined, we're in the midst of an incredible bull run, and the metal is already up year to date, even after the sell-off that we saw end of last week. Nomi, what do you believe are the biggest drivers behind this precious metals bull market if we look big picture and zoom out for a second? And what is the state of those drivers today?
There's multiple drivers, and a major one is geopolitically motivated. We did see gold, for example, as kind of the first precious metal to really start to accelerate before silver, before platinum, before palladium, and so forth into this latest, let's say, 3-year period since mostly March 2022 when Russia invaded Ukraine. That story's been told a lot, and sanctions were imposed on their financial and their cash positions, but they couldn't be imposed on their physical gold position. So more gold was acquired, more gold throughout the world was acquired, but there's more than that going on. Gold is becoming more and more of a collateral, even if it's not officially a standard in international trade. And as a result, central banks have been on a spree to buy gold. They're only 25% of the market, but they've actually pushed a lot of the momentum and the focus on gold by being a steady 25% of the market and buying over 1,000 tons of gold per year, as they have over the last several years. And also in gold, there is a bit of supply problem coming up in that the amount of gold mined, it hasn't gone down. It's not at a deficit like silver, but again, it takes a while to bring a mine to pass, and we only saw a minor, like a 1%, which is basically nothing, increase of gold last year to levels of 2018, which is now a number of years ago. And so there's not a lot of gold coming into the market. So that's also a driver, is that the future scarcity of gold, which isn't talked about that much now, is really coming into play as this current momentum towards central banks and geopolitical positioning around gold continues to increase. And then you add to that, gold is a diversifier. Gold has a much bigger story because of that, because inflation had knocked in a few years ago and people were looking for ways to accommodate inflation into their portfolios. Because at the end of last year, for example, Morgan Stanley suggested to all of their high net worth and other clients that individuals should be invested in 60% equities, 20% gold commodities, and 20% bonds, as opposed to 40% bonds. I mean, these are big shifts that also start to bring in institutional investment and retail investment. And then you look at the supply chains, like we talked about silver, platinum, palladium. These are all commodities that are at deficits and that are very concentrated in certain parts of the world. That if those mines are disrupted, there's not a lot of supply to come in elsewhere to accommodate that. So what we're seeing is multiple reasons for the entire physical commodity chain. I'm not talking about oil, but metals, minerals, and so forth, having increased over these last few years, in particular last year, as people were noticing more, that really span a lot of factors happening at the same time.
Masterclass in unpacking that, Nomi. I would love to continue talking about the central bank driver for a second longer, 25% of demand like you outlined there. Recently, of course, it was well reported on that gold as a holding passed US treasuries. Of course, it hasn't passed the US dollar as a full holding for central banks just yet. How much further could this central bank buying drive us? And should we expect a return to, for example, 70 or 80% gold holdings like we saw in the past for central banks?
Well, right now, most of the main central banks that have been stockpiling gold, including People's Bank of China, which has been one of the main leaders, and also obviously for geopolitical and monetary anchoring reasons, they're still only at 5 to 6% of their reserves in gold. So yes, they have sold treasuries over the years. They have not restocked treasuries. And for example, People's Bank of China is now at 50% of the levels of treasuries that they held in 2018. So there's certainly been, and throughout the central bank space, there's been a decrease in treasuries as treasuries have just amassed in the size of their own, debt to $38 trillion of public debt right now. So to get to 70 or 80% gold, that's a stretch. But you don't have to get much higher than where we're at right now to really push the price of gold up. We did an analysis at the end of last year, when gold was about 4,500, so just around late fall of last year, where we took a look at the BIS reports, Bank of International Settlements, the Central Bank of Central Banks, and we looked at them back to the 2008 period, after the financial crisis through now. And we looked at the increase of physical purchasing of gold as a percentage to now. And there's still a deficit, there's still a gap of a need to buy 1.5% more of total reserves in gold right now to get back to 2008 levels when nobody was talking about them. And so that alone, and we calculated this at the end of last year, that alone would have pushed gold prices to 5,500, which we saw just over that period, just to get to that amount. So we'll see what this quarter's buying has been, especially with the lower prices and sort of wiggling up in terms of central banks. But just to get even to 2008, we were going to see a mathematical equivalent of 5,500 on gold. That doesn't include all these factors we just talked about and all of the geopolitical motivations to diversify more against the dollar, which there were then in 2008 after a big bank crash from the US. But all these other things that also exist now, which means that, again, we're not going to see 70, 80%. But even if we see 10%, we're talking about, I'm not saying this is happening tomorrow, but we're talking about something like $9,000, $10,000 per ounce of gold. I'm not saying that's where we're going to get to this year or fast, but over the next few years, 2-3 years, it's not unreasonable to see the current increase in gold purchasing and the increase in terms of a percentage of reserves get us to that level of gold.
Yeah, that's incredibly interesting. And of course, like you outlined, there's multiple drivers behind this. One driver that has entered the public zeitgeist recently is the debasement trade. Of course, a trade implies at some point eventually getting out for fiat again. Is that perhaps the wrong way to think about this precious metals hard asset bull run that we're seeing? If we are going into a potentially structurally different next few decades with fiscal deficits, should one potentially stay in hard assets rather than trade in and out?
Yeah, I mean, we at Prinsights, we're very much about long-term investment horizons, long-term investments in precious metals and commodities that have both scarcity value, geopolitical value, economic value, and a part of where the world is going, as well as an investment value. And so we definitely look at things on a long-term horizon. Now, that said, there's different parts, for example, on the gold curve to be. There's buying physical gold. There's buying large miners. There's buying junior miners. There's buying royalty companies who invest across miners and don't have the costs. So really, if we're looking at investment, I think all of these things in different degrees are appropriate for long-term investing. And that's over silver, that's over platinum, that's palladium, that's copper, that's rare earths. This is something that is prevalent, I think, for a good investment strategy across the spectrum of necessary and scarce metals.
With gold trading at new all-time highs, gold producers are printing money. And this means that for the first time in years, money is beginning to flow into exploration. This is a trend that we at Palisades Gold Corp have long anticipated, which is why we spent the last decade assembling the largest junior-held mineral claim package in the United States through our subsidiary Made in America Gold Corp. Made in America Gold Corp holds over 700 square kilometers of prospective ground, located exclusively within America's most prolific gold mining trend, the Battle Mountain Eureka trend. Made in America's properties are are nestled amongst several of Nevada's largest gold mines and resources, making it highly prospective for a potential discovery. To find out more, visit palisades.ca and join us on our mission to make Nevada's next multi-million ounce gold discovery. Now, back to the show. How anomalous are current global debt levels and government debt levels, and how much debasement would we need to see to return to normal or more healthy debt levels?
Well, we haven't seen them go down in quite some time. 38 trillion and counting in the US, which probably will hit 40 trillion by the end of the year or turn of the year, is a substantive amount of debt. We're looking at debt to GDP ratios about as high as they were during World War II, and in some countries a lot higher. I don't see a world where that debt is going to be repurposed to growth or economic development fast enough to substantively reduce that debt to GDP level. And so I don't really see us in a world. I mean, I would like that if I were running things. I would redistribute a lot of that debt, and as opposed to sitting on the books of central banks, or as opposed to being wherever, be repurposed towards backing legitimate development projects. But that hasn't really happened. We've not seen that. There's no viable plan in the world to really reduce debt. Now, you can get out of some of it, and that's what we are seeing, by leveraging commodity value into the growth that is happening, into the infrastructure that is happening. So you can make a dent in it. And certain countries are really trying to utilize their natural resources base in a different way, and have more of a power seat at the global table, leading with their commodities. In Brazil, for example, it's obviously a top 10 economic economy, but at the same time, it doesn't have the power of the US, but it does have a lot of natural resources. And rather than just exporting them, it's looking at ways to process them internally and to start to compete with China, who's processing most of them internally for the world. And so there's shifting, but reducing meaningfully requires the kind of development that I just don't think the world is fast enough to do, or at least as a whole.
All right. You mentioned the last time we saw debt to GDP ratios like this was around the Second World War. And of course, we also had significantly different demographics worldwide. Right now, we have a declining birth rate almost everywhere in the world. I believe there's only one or two countries that have an increasing one. How much worse does that make the problem that we're facing?
That's really interesting. I mean, I think a lot of, and I'm not a study. I don't really study demographics as my main thing, but certainly the less people you have coming into the world, there's two reasons. One is because it's expensive to raise a family, particularly as the cost of things are higher, debt burdens are higher, etc. But also that means, yes, less people to contribute to the workforce or to contribute to development. On the other side of that, you have AI, which can sort of not replace people, but requires energy and requires metals and minerals to basically be active and to grow. So you have that sort of as a counterbalance. But yeah, definitely, if we see economies that are used to having more work and more individuals in the workforce, not seeing them, that does reduce the type of economic growth you can have.
So when we put all of that together for gold specifically, does that mean that we might not anymore be in the early innings, but we're also not close to the last innings?
I still think we're in the early innings. Because we did see a substantive increase over last year, over the last 3 years. If you zoom out further, silver took a while to catch up and really spent last year catching up and surpassing gold. Then we had that sort of main drop last week, and now we're sort of rebuilding from there. But really, if you zoom out, it's still quite an upward path. I really think we're in the early innings, and again, because I don't see the world going backwards in terms of geopolitical sensitivities anytime soon, with the momentum that's happening in terms of critical minerals being at the crux of a lot of national and international strategies. I don't see that happening. The U.S. just launched its vault strategy. It's had so many critical mineral strategies under both administrations over the last 3 terms. China has been building. Countries throughout the world are reassessing the value of their their stockpiles and their contribution on the critical minerals stage, it's not, this is something that I see going forward. And as a result, the demand for these metals, these minerals, for all of their reasons, is going to increase. And it takes, again, a long time to bring mines online. So that time gap between supply and demand, if you consider that it takes to find a new mine, to get permits, to do all these things, can take anywhere from 10 to 25 years, right? So if you look at it like that, even if we had maybe an immense starting period over the last year and a half of increased momentum over the last 3 years, you're still looking at, if you look at a baseball game of 9 innings, still only first and a half inning of the game.
All right. And of course, that brings us to that interesting field of this critical mineral war, or at least tension that we're seeing between the East and the West, trying to get these supply chains and having stable supply of these important metals. Can you outline for the West, how are our supply chains currently looking, and how reliant are we on the East currently for those critical minerals?
Yeah, I mean, rare earths are one main of all the critical minerals. All 17 of the rare earth elements are on the critical minerals list, strategic list for the U.S. and for other countries. 90%, 80 to 90% are processed in China and come back to the United States through those channels, and 60% are located in China or regions that are very allied. So that's just like one component of 17 of the 60 critical minerals right there. If we look at silver, about 67% of that is processed in China, and they're putting out export controls on processed silver. And copper is significantly processed outside of the U.S. And so really, if you look at the entire battlefield, if you will, of critical minerals and metals, it's not just about even where the supply is, it's where they're processed. It's a bigger chain than that. And right now, if you did a ballpark average of the critical minerals that are needed and where they are outside of the U.S., which is what the U.S. does to come up with the U.S. critical minerals list, you're basically looking at about an 80% sort of total cumulative average of things that are needed being processed outside of where they are needed, from the standpoint of the East to the West. So there is a significant gap. It has existed for quite some time. It's just that right now it's coming more into the forefront.
Yeah, that processing point is of course incredibly important, because like you outlined, there's an enormous gap for time gap between a mine being found and being put into production. But for processing, that gap also exists, and we don't have the technology in the West to process any of these materials, as China has been doing so over the last 20 years.
That's right.
Yeah, it's an incredibly interesting point, definitely. So is this something that's tradable for an investor at home, this critical mineral list? And do you think we should expect significantly more upside for some of these critical minerals?
Yeah, I mean, I think that the upside to this from an investor standpoint, and one that has a long-term view, again, those are the investors that we see as having the most upside over time, the ones that don't, freak out if silver goes down by 30% for, just a host of silly reasons in a day. But the people that actually, are committed to the fundamentals of what's driving all these markets, there's so much opportunity. I mean, our portfolio, we've got two, basically. One is more sort of the smaller miners, one's larger, and plus all the industries that use them, as well as the commodities themselves. And we look at this on a constant basis. We see so much opportunity throughout the world, and we look at it through a lens of 6 factors. We look at jurisdictionalists, we look at supply, we look at scarcity, we look at, is demand multilateral, and what's happening with central banks, what's happening with governments, and the mines. And there's a phenomenal amount of opportunity out there for investors, like significant 10x in a few years type of opportunity. And I don't usually say things like that. I'm not really prone to exaggerate those sorts of returns, but doing the math and looking at the factors, and again, it's not every mine, it's not every miner, it's not every tech company that processes this material, but there is a phenomenal amount of opportunity out there.
Excellent. I would love for you to talk about Prinsights Global for a second.
We run a Substack, among other things, which is where most investors can find us, which is prinsights.substack.com. There's multi-tiers there, 2 of which are paid, and they have different degrees of analytical support. Both of them have investment strategies on a regular basis. We maintain our portfolios, we maintain buy up to levels, we talk about selling to capitalize and move to a different part of the supply chain throughout. So it's a very actively analyzed product set. So I encourage people to check us out.
All right, I'll put the links in the description. Dr. Nomi Prins, thank you so much for your time and insights today. I know you need to run. Really appreciate it.
Thank you so much.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their CEDAR Plus at www.cedarplus.ca.